Hello, I'm Roel Rollocks, founder and lead business coach at VisionWorks. And today I would like to introduce you to morning affirmations at VisionWorks. We are proud and excited to bring to you a technique utilized by many top performers in just about every field of endeavor. So what is an affirmation? An affirmation is an oral or written statement confirming something to be true even when you don't feel like it. VisionWorks affirmations are simple, positive statements declaring specific goals or outcomes for your day. These empowering declarations can have profound effect on the conscious and subconscious mind. So why affirmations? Positive affirmations can help you create positive emotions, which can improve your mental, emotional, and physical health. The awareness that affirmations produce makes you more likely to challenge negative or defeating thoughts as they arise. Research on affirmations indicates that they can boost your problem solving and decision-making skills, help you to perform better under pressure, help you to focus on abundance rather than lack, and develop an attitude of gratitude. So how do you make the best of VisionWorks morning affirmation? First, find a place free of distraction. Secondly, remain calm. Smile if it feels natural to you. Say your affirmation slowly and clearly. That's number 3. Fourthly, repeat the affirmations at least 3 times, really focusing on the meaning of each word. We are convinced that these affirmations, when added to your daily routine, will empower you for greater impact. So look out for more of our promos and subscribe, and you will receive our podcast once a week that you can repeat daily to set your day on the right path. See you on the inside. Good afternoon and welcome to Proven Strategies for Overcoming the Burden of Debt. But just before we get into it, we'd just like to spend a moment remembering the times that we're in. We are here today talking about how to get out of debt. There are some persons in even more dire straits, battling with health. We are talking here about the pandemic. Maybe you have, but certainly in my sphere, we've lost loved ones. So at this time, we want to spend a couple moments just remembering those persons who would have gone on, remembering those who are still on the forefront, fighting this scourge, the first responders or medical or security or police officers, and all the essential workers. So we're going to take just a couple moments in memory and to remember these persons before we begin. Hello and welcome again. My name is Roel Rollocks. Welcome to Overcoming Debt. We're looking at today proven strategies for overcoming the burden of debt, put on by VisionWorks Solutions as part of our Financial Friday program. As I said earlier, I'm Roel Rollocks, and I'm the founder and impact consultant at VisionWorks. VisionWorks is a team of business consultants, trainers, and coaches committed to helping individuals like yourselves and businesses thrive in today's very volatile, often uncertain, complex, and ambiguous world. Some persons refer to it as a VUCA world. What we do is that we guide our clients. We guide them to unearth their creative genius, and we direct these efforts towards innovation. In this way, we have seen great ideas being fueled that foster sustainability and create transformational impact that yield harmonious personal and business success. Today and every financial Friday, we focus on financial well-being and prosperity. As a certified financial planner for over 20 years, I've seen and I've experienced personally what financial distress can do to the best of us. Indeed, I have my own stories, and I'm sure many of you listening in have yours as well. And you can share the challenges that you face. So, what's our rationale for Financial Friday? We, a couple months ago, did a survey called How You're Making Out. We put the survey out and you replied. Of the many things and the issues that you brought up, three things came out on top. You had fears about the coming months. How were you able to continue to earn money for you and for your loved ones? There was also fear about how you're going to manage your debt. And that's why we're here today, in addition to issues related to budgeting. So we responded by bringing together individuals through this series that focus their time and energy on helping persons like yourself financially. Our program today consists of three main presentations. We have a very excited, bunch of panelists today whom you'll meet in just a moment, right? They each will present what their particular topic for just about 5 minutes. After each presentation, we're going to engage our panel. We're going to have a Q&A for just about 5 or 6 minutes where you'll get the opportunity to post your questions in the comment section. To do this, you'll need to use the hashtag, and we'll have this posted in the comment section for you. Hashtag ask presenter's name _question. So each presenter is passionate about seeing individuals achieve personal success. And the ideas were developed with you in mind as part of their practice as well, especially during these pandemic times. So without further ado, let's meet our first presenter, Mr. Richard Rollocks. So Mr. Richard Rollocks is a finance and investment coach and actually part of the VisionWorks coaching team. So he's here to present on the topic, understanding debt and credit. These are words we hear all the time and maybe we mix them up. What do these words mean and why are they important for us to understand as we approach this topic of managing debt? So introducing Mr. Richard Rollocks, financing and investment coach.
Hi, good afternoon. Thank you all for that wonderful introduction. I must say I'm very excited to be here. I think it's a very contemporary conversation, discussion that we all must be having about debt. I want to thank VisionWorks for this opportunity to share some of my knowledge. I think knowledge is something that is transferable. So I want you to help me and me so that I can help you. We can all come together this afternoon and leave with a better understanding of some of these financial terms. I think in today's world, a lot of people are very daunted by terms that are being thrown around. You go online and sometimes they seem, a little bit onerous, a little bit, dangerous for you. But we want to make it very, very simple this afternoon at VisionWorks. That is the key. So, this whole concept of debt, I want to speak a little bit about the concept of debt, and then I will branch off speaking about credit. And sometimes I know people use it interchangeably, but they, when you think about it, they're not exactly the same. So, as an individual, you always hear people, you're growing up in a household, you hear about debt, and it sounds like a very scary word. And, a lot of people tend to shy away from it. So I'll just say, come on, what is debt? So ideally, debt is money borrowed by one party from another. So anytime you borrow money from another person, that essentially is debt. And what you will find is that debt can come in many, 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 many forms. Corporations, for example, and individuals, they use debt, as an opportunity to make large purchases that they could not afford under normal circumstances. So anytime you borrow money, that is considered to be debt, right? And but the good thing is that debt is not something to fear. What we have to come to terms with, debt is something that we can manage. We just have to be able to develop the skill set to manage debt. I know sometimes people say, well, they don't like debt, they don't like to have debt. But when you think about it really and truly, debt is really necessary for our total existence, right? Um, Debt essentially can be categorized into four main categories. You have unsecured debt, you can have secured debt, you can have revolving debt, and you can have mortgage debt. And you may hear some of these terms in your daily experiences dealing with financial institutions. And I would just go through what these things are very, very quickly. Secured debt is really debt that is collateralized, or debt that money, if you borrow money from a bank, for example, you go to a bank or financial institution, or even say a friend, and you ask that friend to borrow $100. The institution or the individual or the person who is lending you the money will essentially ask you for some sort of security, and that is to cover their risk of not being repaid. So that is what we consider to be collateralized debt. And collateral could come in the form of assets. Collateral can be cash. Collateral could be services as well. So it does not necessarily have to be, hardcore asset. It depends on the financial institution. And in this world of fintechs, you have other forms of collateralizing the debt. Unsecured debt is actually debt that does not require collateral. And that is the debt that I think most people are familiar with, simply because everyone wants to have something for nothing. So if you could walk into a financial institution today and say get $100,000 or $50,000, and you don't have to give them anything in return, it sounds like a really, really, really nice price, a really, really nice idea. But I can assure you it comes at a very, very high price, because what we don't understand is that unsecured debt usually comes with attracts the highest interest rates. And then there is revolving debt. A revolving debt is more so debt, or like a line of credit, whereby the borrower could continuously borrow from a specified line. So, for example, if I have a line of credit with a financial institution for 100, say $50,000, it means that I can borrow up to I can, if my account is empty, I can borrow up to 50. If I go into deficit, I can go into deficit up to $50,000, and I can repay it. And then after repaying it, I have access to that money over again. And then there is mortgage debt, and mortgage debt is really collateralized debt, but it's collateralized debt when we're speaking about real estate. So again, debt is money that is borrowed from one party to another. And this afternoon at Vision Works, the key about debt is that we have to understand that debt is important, as I say, to finance our goals. We might have short-term goals, we might have medium-term goals, we might have long-term goals. Some of our goals may be, say, getting to school. Some of our goals might be a health concern. Some of our goals might be education, or it might be a mortgage. And what is important is that depending on um, what your goal is, will determine what kind of arrangement that you will be getting into that with that financial institution or with that individual. What I can say is the most common and popular debt, and when I say most popular, and I mean easily accessible, is credit cards. Yes, I may work at a financial institution, but I can definitely say um, that credit card is one of those debts that are very, very difficult to manage. And the reason why it's difficult to manage, because debt or borrowing money is usually linked to your ability to be disciplined. And if you don't have that discipline, then you will find that an individual can run into a lot of problems. Because credit card debt usually, sometimes people misuse a credit card, and it's not there to misuse. It's they misuse the credit cards for, just for our impulses. So we want to buy something to look nice, or we just want to go on a trip because we can. These are why some people use credit cards. And I mean, if you don't already know, credit cards, at least where we are in Barbados, credit cards attract the highest interest rates. So the interest rate on a credit card can go up to 21 to 26%, depending on the credit card. And then you still have you're charged in terms of your monthly um, balance. You charge 3% on purchases, and some people try to get cash advance from these cards, and that kind of makes it a little bit difficult. Um, so is debt bad? No, debt is not bad. What is bad is when on borrowing money that the individual does not stick to the particular terms and conditions. And that is because all debt, regardless of what it is, there are terms and conditions. Some of the terms and conditions on a debt would be um, the timeline, the time horizon you have to repay that particular debt. And sometimes we don't think about the interest rate. So when you're looking at debt, what we have to consider is, what price, and the interest rate is really that the person who's lending you that money, that is their reward, or what they're charging for their risk of lending you the money. So we have to be very careful with how we use that and how we use it. Now, as I say before, sometimes you might have different types of debt because you have different types of financial goals. But from time to time, it's always important for us to look at the varying interest rates that we are borrowing at, because that can land an individual into a lot of problems. And we will speak about the problems when we start to speak, when I go into the concept of what is credit. So that depends on how you look at it, can actually be a good thing. But in terms of credit, we have to be very careful. And one aspect of debt that I did not speak about just now is, for example, corporations use debt. They issue debt for, in the form of bonds to raise capital. So other than a shareholder, say, putting money into a financial institution, some financial institutions decide that they will raise that money by going to the market and issuing a bond. Or essentially, they might go to a corporation, another corporation, or they might go to the public, and they may actually give a stake, equity stake in the company for a return over a fixed period of time. So for those of you who may be a little bit financial savvy or might hear of the terms, assets is equal to um, assets equal liabilities plus shareholders equity. That is what I prefer to use. You might know assets minus liabilities is equal to capital, right? But when you think about it, um, most assets are really funded by a combination of debt and a combination of a shareholder or an individual putting funds into a company or a project. And as I say, there are different types of debt, and there are different stipulations under which you will borrow debt, that you will want to have debt. And this leads me to the next conversation we want to speak about this afternoon, which is credit. So, what is the difference between credit and debt? So, just to recap, debt is essentially money that is borrowed from one party, from another person to another. Credit is the ability to borrow that money. And why I say the ability? Because, say, for example, on layman terms, if um, if you're a parent, and if you're or say, for example, you're say in a typical brother and sister relationship, a particular friend and friend relationship. If you borrow money from your friend and you do not repay it, then the person who would have loaned you the money, they would be very risk averse to lend you money again if you were to approach them. And in essence, it affects your credit, which is the ability to borrow funds. And what financial institutions are the financial institutions sometimes look at? Some financial institutions look at what we'll consider to be a 4M model. They would basically look at a particular risk category for lending money. So credit is the ability to borrow money or access goods with the understanding that you will have to repay it later. So not everyone will fall into the same bracket of into the same category of credit. Some people may have poor credit. Some people may have very weak credit, and that is dependent on how that person has been servicing their loan. And as an individual, you may be asking, what is good debt? Essentially, for consumer loans, what most financial institutions would look at, they will look at something called your total debt to debt servicing ratio, or your TDSR ratio. Ideally, financial experts have come up with an equation or a ratio between the amount of money that an individual may borrow versus the amount of money an individual earns. And that ratio, typically, I know for some institutions, ranges about 40%. And what that means is, it means that one individual should not have um, borrowings in excess of 40% of their particular salary. So, for example, if someone works for a salary of $10,000, a financial institution would say, if it is that your loans or your debt or your liabilities or the people that you owe is in excess of 4,000, then that your ability to take on more debt or to borrow more money will be risky. And some of there's different ways that we can address and seek to address that. For most financial institutions, you will hear the word debt consolidation, and debt consolidation is one of the most popular methods of dealing with that. And what that essentially does is that it will take the different types of loans that an individual may have, for example, like your credit card debt, and then they might look at, say, a car loan, and they will try and put it all into one particular loan. So that's essentially it. I know you will have some questions, and I'm here to answer the questions. Feel free to let me know. Thank you very much.
Great. Thank you very much, Richard, for sharing that and making that distinction between debt and credit. So what I want to do now, we'll bring the panelists on screen. But while we're bringing them on, Richard, I'd like you to consider, you mentioned earlier that debt, you need, when you were talking about credit, you mentioned that, if you do borrow from someone and you don't pay back, all right, it affects your credit, so would you say credit and credibility seems to be two linked words? In other words, you're losing credibility with that person? Would that be another way of looking at it?
Yes, definitely. I would say that's another way of looking at it. Credit could also translate into to trust, right?
Right.
It can translate to trust on one hand, but it also speaks about ability, because the more debt, the more loans that you take on, there's a difficulty to service that debt. So
Right.
there's trust on one side, and then there's the level of debt on the other.
So I see we have our team. We have Mr. De Freitas, consultant financial analyst, and we have a personal credit consultant, Mr. Daniel Thomas. Nice to have you guys, and we'll be getting a deeper introduction of them a little later, right? So, Mr. De Freitas, so would you say that we should borrow at all, given the reality that most persons fit into a particular income bracket? Should we really borrow and engage debt at all?
Yes, I believe so. There are very few cases where some exceptions where people should not borrow. For example, some people have financial problems, they have problems with bad debt already existing, and they really need to take a step back and manage their situation. But other than that, one of the points that came out, and Richard's presentation was excellent. I really enjoyed it. And one of the things I'd like to add to what he said is that the reason for borrowing, really, and it brings home a point about a friend of mine, a close family friend, who is 82 years old. And she worked for 42 years of her life, and she built two homes. One in her mother's yard. They have a large yard, and she built a nice big apartment there. And then when she retired at age 60, she worked at a good job. She had a good pension and so on when she left at age 60. And when she retired, she purchased or she built another home from scratch. But here what? She never, and up to yesterday, she telling me, she said, listen, I never borrow a cent to build any of them homes, you know. But you know what she tell me? She said, but I have one regret. I say, what is that? As if I don't know it. She say, boy, I regret not taking any loans now because I would have preserved my capital. And that is really the crux of, you know, why we should borrow for productive and provident purposes, that we preserve capital. Once you could find a suitable home for that capital to get some returns on it, of course you should borrow.
Is this what the financially astute and the certain percent, I wouldn't say the percent, called leveraging? Is that
That's
this what they
right.
call? Okay.
Yeah, because let me tell you what happens there. Governments around the world, sovereign governments, large institutions and corporations, right? The banks and so on. When a bank have a capital project to do, they would not use their capital, right? Is one large company in Trinidad that are still ashamed to say went and purchased some large assets out of cash flow about 12 years ago. I don't know if you all could remember that debacle, right? They went into cash flow, a company that have problems already, and they went and buy 5 large assets, right, to provide a service. I wouldn't call the name for legal purposes, but you know, you went into cash flow and you pay for some large assets to bring income. That is how the world revolves. That makes the world go wrong, really.
Yeah.
You know.
So what we're saying here, gentlemen, I'll bring you in, Mr. Thomas, is that we shouldn't fear debt, but there's a way to do it. You understand? And I know a little later on we'll be talking more about dealing with debt and how to get out of it, you know, Mr. De Freitas. But Mr. Thomas, what's your take on it? And this whole idea of taking on debt. Should we take on debt? How should we take on debt? What's your thought on it?
Well, I believe based on my experience, knowledge that I have in debt is important right now for everyone to get themselves involved in. Because the way how the economy and the world is going, actually, you have been monetized based on the debts and the loans, all right, and the ability to repay back. So it is important to start young with small micro loans and build your credit rating in order for the financial institutions to see that you are capable of repaying your loans. And that will also, in turn, raise your credit score, right? So when applying for a larger loan in terms of a vehicle loan or mortgage, they actually see that you have over 15 years of experience in repaying that loan perfectly. So it wouldn't have no problems in lending your loan. So I believe that debt is important right now.
Oh, I see a question coming in from Denise Alyong. Is it advisable to mortgage your home to access financing for business purposes? Is it advisable to mortgage your home to access financing for business purposes? Thank you very much, Mr. Thomas. I'll put this one to Richard.
Yeah, okay, thank you, Denise. That's a very, very good question. What I will say is, you know, the decision to mortgage any asset really comes down to the individual. You know, it really comes down to, you know, what is the risk appetite of the individual. Because obviously, if you mortgage your home, which is especially, and when I say home, someone can have more than one house, right? But if it's the residence where you reside and your kids and your family exist there, then you have to be very, very careful, because you know the chance of losing that if the business goes belly up, you know, is a reality. So it depends on the risk appetite of the individual, of the family, of the husband and wife, or if it's a single person, all depends on the risk appetite. But a lot of people do it. So it's kind of a personal decision, because then we have to go into what type of business. And COVID-19 has shown us that, you know, there is no 100, you know, there's no there's no business that will be resilient to anything. COVID has thrown that out the window. Any business could go belly up at any point in time. So we have to be very careful of how that is done.
But it raises a very interesting question, though, and I've heard this. Maybe you gentlemen have heard this before. The idea that most people actually don't qualify really for the loans. What they do is they put something on paper that the bank would like to approve, and they hide a lot of their debt, but they have a high propensity to take risk. And what I hear some persons on the street saying, if they don't do it, you understand, they will never access a loan. So this goes to the point you're making about your propensity to take risk. Is this really where we're at right now, where, you just have to take the risk?
Yes. So, like anything else, you have, the whole concept of risk has to do with the type of risk, and risk must be measured. It's not just taking risk, taking sake. It should definitely not be linked with, an emotional decision, because, sometimes we can end up into problems. And we've seen, when something is emotional, it goes up and goes down. It might be a fad. That feeling might disappear tomorrow. So we have to be really careful. One of the things I will say, though, what some people do, some people tend to, if they own a home, they might buy or put some money on an asset, say like a piece of property or land or something else outside of the substantial home for the future purpose of a business, right? And sometimes that works for them, but as again, risk is fine, but it must be measured, it must be calculated, because at the end of the day, you could suffer severe setbacks.
Great. So I take it from what we're saying so far is that debt in and of itself is not a bad word. All right. There's a thing called good debt. And if we plan properly and we prepare properly, we are able to take advantage of it. Right. I see a question coming in from Merlin Rollocks. Thank you very much. Is there an age at which you shouldn't borrow? Is there an age at which you should stop borrowing? And we'll take this as the last question before we move on to our next presenter. I don't know who would like to take a shot at that.
Yeah, I could take that one. Thanks.
All right.
Yeah. So the thing is, and that's a really good question, because from institution to institution, the policies vary a little bit in terms of age and limits to borrowing, right? So generally, in the cooperative credit union movement, for example, some credit unions would lend people up to the age of 70. They would give them whatever the multiple is over their shareholding. So if you have $100 in shares, some credit unions will lend you up to $200 or $300 up to age 70. That is the age at which most insurance companies cut off. Somewhere between age 65 and 70, they would cut off coverage for if you were to die, they would pay off the loan. So a lot of institutions, what they would do is the banks would allow you to pay for your own credit insurance. But at the end of the day, when you are not insurable again, what they do is generally lend you up to your collateral. So if you have a fixed deposit with the bank or the credit union, you have shareholding in the credit union, they would generally lend you up to that asset value. But I just want to go back to the question before from Miss Aliong Thomas. She's a personal friend of mine. She and her family, I know them well. They're close friends of mine. I just wanted to add a little bit to the answer that she was looking for. I think the answer was given was very good. But I just wanted to add to it. One of the things with borrowing from using your home as collateral to invest in a business, that is one that my advice on that would be always look at the equity that you have in your home. So if you purchase the home for $100 and you're owing $80 on it, right? It means that the equity is $20. That $20 is what I would advise not to go beyond. That equity value, that excess equity is what I advise, don't go beyond that. The reason being, no matter how good a business plan is, it is considered in my books as speculative, right? It's similar to investing in the stock exchange and these sort of things. So my advice is always negotiate what you borrow against your home, in the sense that don't go over the equity value of your home, because just in case the business goes belly up, you could still negotiate on that level to get some grace as opposed to taking the whole value of your home.
Yes,
You
leaving
know,
yourself
if your home
exposed.
value
Yeah.
$1 million and you're owing 800,000, don't go and borrow $1 million in it. You understand? Thanks.
Thank you very much. Yeah, thank you very much, Mr. De Freitas. One of the things I see that Ms. Alyong is teasing out as well, and hopefully we'll be able to address this coming down to the end, because we're going to now transition to Mr. Thomas for his presentation. And the question is, borrowing, but for business purposes, because people take out home equity loans for all kinds of purposes. Sometimes they do refurbishment, they change a roof, they put up some fencing, they replace some worn fence or wall. But in this
Correct.
case, we're talking about for business purposes. And maybe
Business.
we'll get back to that question. But for now, thank you very much, gentlemen. We want to move on to
Okay.
Mr. Thomas, right? So Mr. Thomas is a personal credit consultant, and he is going to spend some time talking to us about this whole issue of our credit score. And in our last session, it came out somewhat the importance of building some sort of credit, particularly the world that we're in. If you don't have this credit, it may really affect you operating in this high-tech world that we're moving into. So I'd like to present you Mr. Daniel Thomas, and he's going to share a little bit about understanding your credit score.
Nice. Thank you. Thank you again, Mr. Rolex. Thank you again, VisionWorks, for having me here this afternoon. And the reason why we are here is to discuss your credit score. All right. Actually, how this thing started, we're looking at in 2002, 2004, where Trinidad and Tobago had signed a contract with Transunion and a company called Infolink, right? They had formed a company called CRS, which is the Credit Reporting Service Limited, right? And that's how actually the credit reporting service comes to Trinidad and Tobago since in 2004. So let's go on to what is your credit score. Your credit score is one of the most important measures of your credit worthiness. For your FICO credit score, or just your credit score on the whole, it's a 3-digit number, usually ranging between from 200 to 850. And it is based on a matrix developed Fair Isaac Corporation. Those are the persons who designed the credit score system. The higher your credit score is, the less risky you are to lend. By understanding what impacts your credit score, you can take steps to improve it. All right. So there are 5 pieces of your credit score which you're going to discuss. All right. So your credit score is based on the following 5 factors. First is your payment history. So your payment history accounts for 35% of your credit score. This shows whether you're making payments on time, how often you miss payments, how many days past due or date you pay your bill, and how recently payment have you been missed. Payments made over 30 days late will typically be reported by your lender and hurts your credit score. How far behind you are in your bill payment, the number of accounts that you show late payments, and whether you have brought the account currently are all factors. The higher your proportion of on-time payments and the higher your scores will be, every time you miss a payment, you negatively impact your credit score. So what we are saying is that TransUnion is the one who takes reports to the financial institutions and put this information on your credit score. So it's important to make sure that you make your payments on time, especially when you're granted a loan or your credit card system. All right. So we're moving on to the second part is how much you owe. That's the next important thing. How much you owe on a loan and a credit card makes up another 30% of your credit score. This is based on the entire amount you owe, the number types of account you have, and the proportion of money owed, compared on how much credit you have available. High balance and mixed credit cards will lower your credit score, but smaller balances can raise it. If you pay on time, your loans with little payment history may drop. Okay? But loans that are closer to being paid off can increase it because they show a successful payment history. The length of your credit history, that's another thing we had mentioned, that based on the length of your credit history, it is important to take microloans and start to rebuild a credit history. So the length of your credit history accounts for 15% of your credit score. The longer your history on making timely payments, the higher your score will be. All right? So the credit score model generally looks at the average age of a credit when factoring the credit history. This is why you should consider keeping accounts open and active. It may seem wise to avoid applying for credit and carrying no debts, but it can actually hurt your credit score if a lender have no credit history to review. So what basically we just discussed it shortly is that most people they tend to jump from bank to bank, but not actually building a relationship with the financial institution and not actually taking loans from the financial institution. So they are hearing that we have a Republic Bank or Scotiabank have a cheaper interest rate, so we close off our account by Republic to go across by Scotia, but not having a credit history that will damage basically your credit score too. So it's important when somebody banking to build a relationship with the bank to take micro loans, leave the monies inside and just show that you could actually pay back that loan. That will help actually increase your credit score too, right? The fourth one is a type of account you have makes a 10% of your credit score. Having a mixed account, including installment loans, home loans, retail, and credit card, may help improve your credit. So we discussed shortly there where if it is good to get into debts. So definitely, yes, we are seeing it is good to get into debt. Debts are actually good, but it's how you manage the risk and how you manage the debts. That's where the important factor come in, right? So making payments on time will actually increase your credit score, right? Having a history with the financial institution and also multiple loans, making small monthly payments month after month will actually also increase your credit score. So we are on the fifth and the last one where we discuss is your recent credit activities makes up the final 10%. If you have opened a lot of accounts recently or applied to open accounts, it may suggest a potential financial trouble and may lower your credit score. However, your credit score models are also built to recognize a consumer who are shopping for a loan, right? Have a necessary extra risks. So we're saying that we want to open we want to open a bank account in 5 different financial institutions, but our salary is only $3,000 a month and goes to one bank. All right. So definitely we are not looking good. We have to build a history with the financial institution. It's important having a financial institution back in, if it's your credit union or your normal commercial bank. And this will help to increase your credit score by taking loans at a younger age, right? And making sure that those payments on time. And with that history, with that credit history, when applying for a mortgage or again applying for a vehicle, this will actually help, right? So basically, the best way to help improve your credit score is to use loans and credit cards. Responsible and make prompt payment to more credit history shows that you can responsible handle your credit. So guys, again, I'm gonna hand it over. It is important to get yourself in debt and make sure that your payments is on time to help increase your credit score. So Mr. Rolex, I'm gonna pass it on to you.
Mr. Thomas, quite a lot to swallow there. So essentially, you were saying, and that we could bring all the panelists on, that it is important to approach debt and to have debt, and you also encourage that we do it at a very early age. So let me give you a
Yes.
scenario. So let's say I'm 20 years old. I really don't need a loan, but somebody said a loan. I take out a loan for 3 years, $5,000. All right. I guess before that, I wouldn't have a rating. But at the end of that period, is it that my rating is going to be 800?
No, well, actually, don't actually work like that with your rating going to be
Great.
800. So your rating starts from rating 200 to 850, right? So a situation, a person, well, my advice, what I'll give a person who is the age of 20, actually join a credit union at that age. It is important. Take a micro loan of $5,000 and put it into your shares, right? Repay that loan. Now, so upon repayment of that loan within a year and a half, you may now get 2 times the amount of that, or maybe 4 times the amount of that shares. And that's also now you can start to increase now. So you take loan based on 4 times the amount. So you leave back 2% of 2 of that back into the financial institution, and you use 2, right, to do whatever small business or whatever that you need. So it's important to just have just to show that you have some sort of credit.
So what
you're
you're
building
saying?
credit with the financial institution.
So what you're saying, Mr. Thomas, is that it's not like I'm going to get to 850 after one loan. All right? With
No, no, you're not going to get
850
850 to one loan.
being the best score. That will take some time and some history building that
Yes.
over time, you know? So
Yes,
it's not
based
like if
on
I
the
just
size
take
of
a
the
big
loans and everything
loan,
like that.
great,
Yes.
over time,
Yeah.
right?
Yes. It
Excellent.
will take over time. Yes.
Yeah. So how does TransUnion get this information? I go to access a loan, and the financial institution, how do they get this information on me? You know, I
Well,
have done,
as
yes.
Well, as you mentioned, basically earlier on, it's a 20-year-old who going to apply for a loan. He has no credit history. So TransUnion will not have any information on them per se. So it's only when
Right.
you take a loan from the financial institution, it is reported to the TransUnion that yes, there's a loan in progress with Mr. Daniel Thomas,
Right.
right?
So how does this
And when you
reporting work?
start,
So every time I take a loan, it's an automatic reporting, or TransUnion requests information from time to time, just so that our viewers understand how it works.
well, I believe it's automatic reporting to TransUnion and the financial institution because that is the agreement they signed. For all loans that is given out to persons, it must be reported to TransUnion, and that will help with increasing your credit score. So,
Okay.
so when you are reporting if a person do a bad payment after 30 days, that will go into the system, and that will help build the
Okay.
person's credit score. Yes.
Only after 30 days. So within that period, I have an opportunity to fix my situation.
Yes, you have opportunity to fix your situation. It's important to fix your situation during
Okay.
that time.
Okay.
Yes.
Okay.
That's the
Yes.
reason why more. Yes. Go ahead.
Yeah, so what happens too is that there are a lot of institutions like banks, credit unions, other financial institutions generally have to sign on via an agreement with TransUnion. So they would actually have to sign that agreement with TransUnion, pay their fees and so on, right, based on the volume. And TransUnion in turn allows the use of their database.
Okay,
Yeah.
so it's
Yeah,
automated. So
correct.
will personal loans be included? I owe someone, you know, down the road, some good friend, you know, can they report me? Can they say, listen, I lent Mr. Rollocks X amount of money. I am calling TransUnion. Mr. TransUnion, can you help me with this? Are personal loans included?
Well, the only way that could work, Mr. Rolex, is if that person is subscribed with TransUnion and paying their monthly dues as a financial
Correct.
institution.
Okay, I saw
Yes.
we had a question. We had a question coming up there, but it's looking like a long question.
Yes. Yes.
If you
Okay.
only pay the monthly minimum balance on your credit card, will that negatively impact your credit score compared to if you pay more than the monthly minimum balance?
All right. So now we have to understand the use of the credit card. It's not just you're going to max out your credit card and pay the monthly balance, and that's going to help your credit score. So I believe it's actually, guys, you could correct me if I'm wrong, but I believe the usage of the credit card is within about 23 to 35% of the usage of the credit card. Right? So not the entire credit card. And by doing that, that will actually help raise your credit score. And if you max
Ooh.
out your credit card, which means that you need to have proper financial management,
Okay.
and that will actually lower your credit score. Right? So within that 23% to 35%, you could actually use on your credit card and pay back that on time, and that will help raise your credit score. So you have proper money management.
So as once you
Yes.
go over that, you getting into dangerous waters. Anything you care to
Yes,
add,
you're
Richard?
getting into the red zone.
No, it's fine.
Yes. So, Mr. De Freitas?
Oh yeah, I'm good with that. Yeah, because
Yeah.
the thing is, the banks actually love when you're making that minimum payment. But I like the point Mr. Thomas raised about the 25 to 35%. That is
Yeah.
important. You know.
Yeah.
Yeah.
Yes.
Yeah.
Yes.
So
Yeah,
I think
because most of the financial
go ahead.
yeah, most of the financial institutions right now, when persons applying for loan, they will ask for your credit card statements. You understand? So see how you're actually managing your credit card. And that's the way
Yes.
how they now assess your credit score.
Yes.
Right?
Yes.
So it's important for persons to understand, yes, they get 10,000 on credit card, so I'll max it out. We have until the end of the year to pay back. So I'll pay back $500 a month to $600 a month. No, it actually don't work. So it's 23% to 35% of that credit card you're supposed to actually use to be in the correct zone for the for your credit score. So we have to understand that.
And just to add as well,
Mhm.
he mentioned, Mr. Thomas mentioned something that's really important. What's also important when institutions look at the historical performance of, say, like a credit card or a loan, especially like loans that are revolving, because remember, a credit card is like a revolving loan. They look at something we would call swings. So they want to see some type of fluctuation, right?
Right.
Of that debt, not that, okay, as he said, you max it out at 20, you know, if it's 25,000 on the credit card, you hit it 24,000, and it stays like that for months, and you just pay the minimum balance. While it might be good for the bank, it's indicative of poor financial management.
Okay.
Correct.
I see a question coming in from Colleen Medine. Thank you very much. Is it that the higher my credit score, the more money I'm allowed to borrow?
Right. So higher your credit score give you the opportunity to, yes, to get the opportunity to borrow more, but it also works with your salary and your DSR.
Okay.
Right. So as
Okay.
Mr. Richard Rollocks mentioned, based on 40% of your DSR, that's what actually works. So these are some of the things we're looking at. Yes, you have
So
proper
it's not that
credit score.
I have 850, so now I feel I can borrow $1 million because my score is right up there.
Yeah.
It doesn't work like
No,
that.
it don't work so
Because
no, it have to also work with your DSR.
Yes,
and remember,
Richard? Yeah.
credit is the ability,
Mm-hmm.
the ability to repay. That's what it is, really.
Yes.
You know?
Yes.
Or we call it credibility. The
Mhm.
credibility, yeah. So it can sit in front of the financial institution. That's your
Yes.
stand over here, you know, when you have
Mm-hmm.
the 850. So yes, we could have a conversation, become comfortable.
So
Yes.
what we're saying here, gentlemen, that it's very important to understand your credit score, right? It's something that we need to manage, we need to be aware of. But the other thing that it seems to be coming out is that we won't seem to escape this, particularly in this very integrated, automated internet world, technology world. We are going to have some sort of history. All right, there is already an history. And if we do not get involved in the system, is it that we have to just exist offline? Is that what we're saying, that we have to build up some history to be able to enter into the system?
Well, Mr. Rollocks, well, in terms of my experience, right, Trinidad and Tobago tend to follow most of the things that happen into the US, right? And yes, it is important in having a history of credit, because switching to the US, just to rent an apartment, you have to have good credit score, right? And soon that will happen here in Trinidad and Tobago, where persons will have to do a credit check in order to actually rent an apartment, to see, for the landlord to see that, yes, you are capable of making your monthly payments on time.
Wow.
Instead of person coming and paying a first and a last, and then they're leaving by the 3rd month or the 4th month. Right? So yes, it is important to have a history. We may hide from that history, but I believe that it is really important to actually stick with the financial institutions, join a credit union, right, and increase your credit score. It is important for that.
Thank you very much. I see a question coming in from Christiane Lander Maloney. I'm not sure if this was addressed before, but could I have access to my credit score? How can I find out what my credit score is?
Right. So you have access to a free credit score once a year. You could go online with Transunion and you could apply for your credit score personally, and you will get that.
Is that something we have to pay for?
No, for your 1 year, for your first credit score, actually is free. But with the financial institution, they usually charge, I think, is $100. Now, bear in mind, so this is one of the things that I haven't shared. When a person applying for loans and they go to multiple financial institutions, looking or seeking for loans, the more they pull your credit score, the more your credit score drop.
Oh.
Yes, the more your credit score drop.
And what's the rationale behind that?
Well, the rationale behind that, we may say that the first 4 banks see that you're not worthy. So the fifth one, so you try the fifth one.
Okay.
Yes.
Because I know some people try that as a method to get the best loans. So they go to several places to get the best one. So you're saying now that might not actually help with your credit score?
No. So one of the strategies that I help my clients with is actually pull your credit score before, so I work with your credit score in hand.
Okay.
Yes.
Okay.
So
that's an excellent point.
Yes.
That's a good point, because what happens, I mean, I work with 1 or 2 financial institutions, and what we have found is that there are occasions where somebody applies for a loan, nothing is really wrong with the credit score inherently, but bad information comes up, because sometimes 1 or 2 of the signatory companies have a problem with their reporting to TransUnion. I've seen that where they provide wrong information, the person looks like they have bad credit. So it's a good idea actually to check your credit, on occasion. I like that idea.
Yes.
Right. I see a question from Ms. Simone Nickham. If 3 persons have the same salary, salary, would they each qualify for the same mortgage value, or would their credit rating impact what they each will qualify for?
Yes. So again, it have to deal with your credit history. So a person may start working out of 2 years, another working 5 to 10 years with the same salary, but it's all about the history and your credit rating.
Right. It goes back to the,
that
so
will
it
determine your
depends
mortgage.
upon how they
Yes.
spend and how they would have used loans in the past and okay, their rating.
Yes.
But let
Now
me ask
having the
another.
same salary,
Go ahead.
having the same salary, and basically understanding your DSR, again it boils down to your DSR, debt service ratio. That and all will determine if you are qualified for the same mortgage.
Okay.
Right? Because you might have dependents. These are the things that you have to look at.
Okay.
Right. So
I want to ask one
same.
more question before we move on to Mr. De Freitas' presentation. And that is, sometimes people get into a real terrible situation. They basically, you hear about companies being insolvent. They're basically insolvent or bankrupt. And sometimes this is as a result even of a court matter. How does this impact upon your credit rating and your credit score?
Filing for bankruptcy?
Yes. Let's say, you have been declared bankrupt as an individual. You understand? And
yes,
does that impact your credit score?
This will damage it. Yes, definitely that will impact your credit score, because once you file bankruptcy, which means that you're approaching the court and you're filing bankruptcy, right? And this will also
how long
affect
does
your
this
credit
stay?
score.
How long will it stay on the books? Is there time?
Well, basically, is over 7 years. Usually, all credit score information actually stay on the books, right?
Wow.
Now, you have to prove that within that 7 years, you rebuild yourself,
Wow.
right?
Wow.
You rebuild your financial portfolio before you're approaching any financial institution. And still, when you approach a financial institution, you will still have a high risk because you filed bankruptcy already. And again, they will look at it, you might want to file bankruptcy again. Right? So yes, you become a risk factor. Yes, you are a red flag. Yes.
Well, gentlemen, I know there's so much more we could discuss here, but we are going to move on to our last presentation. And thank you very much for your comments. Thank you very much for your questions. Continue to send your questions in the comment section. Hashtag ask presenters name and your question. So now we're going to have Mr. Anthony De Freitas, and he's going to share a little bit about debt management. We've been talking about it, and essentially we want to look at some of the tips. How do we deal with debt? How does debt come about in the first place? How do we find ourselves in these situations? And what are some of the tips to get us out of it? So introducing Mr. Anthony De Freitas, consultant financial analyst. Take it away, Mr. De Freitas.
Thank you very much. Thank you very much, Mr. Rollocks, and good evening, everyone. So one of the first things I want to start with is, so my presentation will take place in two parts. One, how do people get into debt? And the second part is going to look at how do we, or what are some strategies we could use to manage debt and to get out of it if we need to. All right. So how do people get into debt? Now, the first thing we have to look at is the thing we are accustomed hearing is people get into debt for productive and provident purposes, right? That was the first thing we had agreed on. So, for example, purchasing a home, a motor vehicle, sometimes emergency or planned medical expenses, people study, right? You have personal loans and so on, and various aspects of professional development. So all those are good reasons to get into a loan. And of course, one of the things that came out of Mr. Richard Rollock's presentation was that, what I'd added to it was that we need to also preserve capital. We agreed that the world runs on credit. Some people build their wealth on credit, right? So there's a sweet spot between where we borrow for items of significant expenditure or to achieve our major goals in life, like a mortgage, a home, vehicle, and so on, educating ourselves and getting certified. All those are very noble reasons why we take loans. But the purpose is really that all that is premised on having a backup, having money saved and investing that money otherwise. One of the issues that we have in society today is that people are driven to consume. And what we find is that there's a vacuum where people finding themselves in debt a lot of times for very frivolous things and not being sure exactly how to get out. So the second aspect I wanted to speak about in terms of how do people get into debt, I wanted to speak briefly, and I want to take a totally different spin on this. One of the other reasons people get into debt is because of consumerism, right? And I wanted to speak specifically about a new phenomenon, it's not really that new, is actually well over 15 years advanced in the world of business, and it's called AI, artificial intelligence and technology, right? And AI has become so sophisticated, right, that there are apps out there that people use. There are apps that you could use that you could actually set it to buy and sell stocks on the US, on the Japanese, on whatever stock market around the world that's on the app. And you could actually set it to buy and sell stocks over a period of time in a particular curve. It could be a growth curve and so on. And you could actually make money like that using what they call bots, right? Further to that, you go in online, right? If you notice, everybody online now, we just laugh at the kids and the young ones, the Gen Ys and the Gen Zs. We just laugh at them and we see them almost getting knocked down crossing the road because their head always on the phone. What we find is that there's a whole phenomenon over the past 15 years with sites like Amazon and so on, these consumer-based sites that allow people to purchase things online. And what is happening is that there are algorithms and bots and various types of technology that are set on the internet and allow you to click on those things, enroll in various services, and next thing you know, you're getting bombarded with mail, you're getting offers, you're surfing, you just check out shoes on Amazon 2 weeks ago, all of a sudden you work a morning and you see something blinking. Brand new shoes from Aldo. It was $89 when you look at it last week, now it's gone to $49. And you ignore it, and next thing you know, within 3 hours, you see same shoes, half price. Next thing you know, you have free shipping and so on and so forth. What is being used there is artificial intelligence. You enroll in the service, sometimes without even knowing. And next thing you know, you're bombarded by advertising, targeted advertising that is geared towards getting you to consume. So consumerism is a major force in the world today, right? So we see advanced digital marketing where algorithms are used and targeted product advertising work together to drive consumption. The result is we have a lot of people, millions of people around the world having all kind of exercise equipment, clothes, shoes, perfume, all kind of consumer products, half of which we don't even use. Sometimes just on a whim, pandemic, depression, people looking to buy and so on, right? The issue with that is that we rack up all this set of debt and we end up in a place where we fall into trouble, right? So how do we avoid, the next phase we're going to go to is, the next segment is, how do I avoid the pitfalls of excessive borrowing? So one, we have to ask ourselves, will this loan, and mind you, a credit card, every time you use a credit card, that is a loan as well. As Richard said, that is a revolving loan. That is what we call a credit. It's like a line of credit. You borrow up to X amount, there's a pre-approved loan, right? So you ask yourself, will this loan, including credit card expenditure, result in the fulfillment of a key life goal or something of value to me or my family and to our development? If the answer is no, run, turn away from it. 2, spend a little less time online or look for different content online, right? Less time online equals less exposure to advertising overload. And 3, we have to educate ourselves about the offerings of various financial institutions in terms of interest rates, as Richard spoke to earlier, and also Mr. Daniel. Amortize, you have to understand the difference between amortize or add-on rates of interest. Financial institutions use these rates cleverly. At one point, the bank used to say, where credit union charging? And people will say, oh, there's charge 12%. And the bank will say, what? They're trying to kill you. 12%, and you will tell them, nah, it's 1% and reducing balance monthly. And they will say, well, here what? I go and give you 9%. But what the rate the bank was giving you back then is not 9% amortized like the credit union. They were giving you 9% add-on, which is actually about 13%. So sometimes they come in a little higher. So one of the things I always advocate for clients to do is when you go to a financial institution to get a loan, always ask them, what is my installment? And you could call or contact, email various financial institutions and ask them, what are your rates? If I borrow $40,000 for 3 years, how much will my installment be? And that's the best way. That is the best way you could educate yourself in terms of getting the best bang for your buck, right? So that is about avoiding the pitfalls of excessive borrowing. The other thing we want to talk about in that respect is exercising thrift, right? And in saying that, what I mean is develop a consistent pattern of saving. Mr. Daniel spoke eloquently about this a few minutes ago. He spoke about developing a relationship with fewer providers of financial services. And I think that is an excellent point. Because plenty times, as he said, we jump from place to place, institution to institution, and we see how it could hurt our credit score and so on, right? So the thing is, join a credit union. You could stay with your bank, whoever you prefer as your provider, go where you feel comfortable. But develop a consistent pattern of saving before taking any loans. And this is a concept we don't know here in this. We heard it earlier from our other presenters. Always develop that relationship, develop that pattern of saving before going for a loan, right? Because when you go for the loan, lenders feel more confident when they see a pattern of saving. And I'll give you a quick one. A particular credit union started a product where it was a loan, a type of loan where you could borrow $30,000. Once you have a low DSR, you come in and they check Transunion on you, and they see that you have a DSR below 20%. What they did is offer you $30,000, and you just pay $50 to join the credit union. You pay $50 in shares, and they lend you $30,000 in your hand. Anybody see any flaws there? Something is wrong with that. If a credit union giving you $30,000 without having any relationship with you, something is wrong with that credit union. I'd be very concerned as a member to put my money there, because they start a relationship with somebody by giving them a loan, and the person all they save is $50. That is crazy, right? So having savings, which means shares in a credit union or fixed deposit in a bank, for example, will provide collateral to make borrowing easier, right? So ensure that you know what rates of interest you would get on savings as well, because that would help you to offset some of your payments on your loan. What some people do, they would join a credit union and wait till they reach about $20,000 or $30,000 in shares. They might get 2 to 4% dividend every year on that, right? And then they would put a next $20,000 as a fixed deposit. And that $20,000 may yield, let's say, yielding $4,800 a year in interest. What the credit union will do is put $400 every month in the deposits. So you could actually live on that, or you could actually use it. You could assist in paying some of your bills, or you could actually take it and pay it against your loan, right? So one of the things I want to point out here is that a credit union is a hidden gem. It is something that you could use as a vehicle to actually encourage your own spending and thrift and your own personal development, right? Of course, I would advise you to also read your credit union's annual general meeting brochure and the financial statements, so you could see what the credit union is worth. And you would see it in, as we heard earlier, assets minus liability equals capital or member equity, right? So members' equity is what the credit union is worth, or any institution. Don't think that because the credit union worth 100 million, that is 100 million for everybody to split up. No, it's 100 million less liabilities. The 100 million is assets. It might have 80 million. It's expected to have about 80 million in liabilities, which means the very money owed to you and other members in terms of savings and shares and deposits and so on. So the equity there would be 100 minus 80, which is 20 million. That's what the credit union is worth, right? The next thing I want to talk about is setting goals, right? So set goals, short term, that is 6 month to 1 year horizon. Then you have longer term goals, 1 to 5 year horizon, and continually compare your borrowing power based on your savings. Always look at your borrowing power based on your savings. And the next item, always have an emergency fund for contingencies. So that way I would advise, always save at least 6 months, have at least 6 months of your monthly income saved somewhere where it's stashed away, that if you get retrenched, if you get temporarily laid off because of COVID or whatever, you have something to back you up and to tie up some loose ends, right? This will provide backup if you were to lose your job or suffer a sudden reduction in salary. This is critical. And the last point is to, before we go into the last segment, is to be confident. Adopting the above measures will boost your confidence when you understand the different types of loans, interest rates, and other information together with goal setting and thrift, which will position you for personal financial growth and security. So the last part of my presentation I want to do is, how do we get out of debt and how do we manage the debt if we are already in debt? Now, the first thing, and if you don't have this, you'll be spinning up in mud, according to you old people. You must start with a disciplined attitude, an attitude of discipline and a willingness to help yourself. Don't study to go to a financial coach alone and get advice. They will help you to prioritize and to see which loans you could pay off first and how you could give yourself some leeway. But you have to have that personal discipline. And the first thing you have to do is to set yourself down and say, I want to get out of debt. I want to manage my debt. I want to cut down my debt. So some ideas we have in terms of getting out of loans. One, look at savings programs. For example, Massy Points. A lot of people don't understand Massy Points. The Massy Point system is an ecosystem, right? Where every time you spend money in their stores or any one of the group of companies, you get points. It builds up digitally on your Massy card, and you could retrieve it. Other companies, for example, I see Food Basket, group of companies, they started offering that about 6 months ago. That is an excellent idea. So get into those type of programs. Sometimes they give more points on certain commodities on certain days. Try to benefit from that. It seems like a joke, but when you add up, those things really do make a difference, right? Two, cutting the cable, right? Now, we would say welcome to the new millennium, right? Where we're looking at information and entertainment on the go, quickly, quick gratification. But we have to look at things when you're in dire straits in terms of getting out of debt. That is the first thing I'd advise people to get rid of. Cut that cable, right? You don't really need it. I would cut that before I cut the internet because you have a lot of other options in terms of watching TV and being entertained, right? The next item, the next idea, stop going out to eat, right? That is a big thing with Trinidadians. I myself have been a big advocate for that for years. But during this pandemic, you know how much money people save from not going out to eat? So that's another way to save significant money. Item number 5, do a meal plan. If you're going to work, do a meal plan. Plan what you're going to cook, what you're going to get ready, what you're going to prepare for lunch every day. Prepare it, buy your groceries, prepare your stuff, and cut out that $50 and $60 and $100 that you're spending every day on food. The next item, number 6, break up with your barista, right? Leave the barista behind. These exotic drinks, that is a total waste of money, right? Plan grocery trips. Some people go to the grocery every day or every other day, right? That wastes a lot of energy. It wastes gas, it wastes your effort, right? It creates more frustration. So try to plan your grocery trips and get what you need once every 2 weeks as best you could. The other one, avoid expensive hobbies, gym memberships, and so on. Some people do it as a means of saving money in terms of preparing themselves, getting themselves fit for their job and so on. There are many other ways that you could keep fit, right? Take a walk. The other one, find free entertainment, cut down on entertainment costs, right? And a big one here, and this one is make a budget. You can't go anywhere unless we spoke about goal setting earlier, directly in line with goal setting is making a budget. When you make a budget, you stick with it, right? You find yourself saving significant sums of money. Now, why am I saying all of this? When you make a budget and you stick to that budget, this amount is for clothes every 3 months, this amount is for food, and you stick within that, you back it up with lists and so on, and make sure you stick to it. What happens is that you free up yourself to be able to make significant payments to draw down on some of these loans. So the last item I'd like to put in the mix is to snowball your loans. There's a technique called snowballing. And what snowballing involves is actually doing a list of all the indebtedness, starting with credit card debt, which is usually the smallest, not for everybody, but sometimes credit card may be the smallest. It might be 10 or 20 or 30,000, right? Then you move down the line. You look at the unsecured loans that Richard was talking about earlier, right? And the personal loans. All those things are generally unsecured, or it might be in a credit union as a personal loan, which means it's secured by shares. So what you have to do with those loans is what we call snowballing. Look for the loans that have the shortest period remaining to repay. So generally, that might be a period of, let's say, anytime between 3 months or less, or up to 1 year. Look for those loans first. And sometimes those loans, because they are unsecured, even though the amount of money is less than the other loans, the payment may be significant. You might find yourself paying $700 or $800 a month in credit card bill. Try to reduce that. Try to put a little more. So look at your overall pie. How much do I have to spend on paying expenses every month? So you make a budget for that. And if you know your budget for expenses and loans is $2,000, what you do is try to apportion that $2,000 in a way that you pay down the smallest loans first and try and take a little excess money, pay off those loans totally, and free up yourself. But the catch is you can't free up yourself to go and take another loan, right? There are people who do that kind of thing. Pay off a loan and give themselves some money and say, oh gosh, boy, I have some breathing room now. And then the next month, you see, they go on and buy some big piece of equipment or some suit or some strippiness and carry up the credit card bill again. So this is where we talk about the discipline, right? One of the other ideas we have to put out there as well is entrepreneurship. Entrepreneurship helps us to generate more income in order to pay down our loans and to get out of debt. One good idea, delivery driving is an excellent idea right now. Even though things are a little slower than usual, you still have takeout delivery and so on. And people pay for that service. I myself pay for that service on occasion when we don't feel to cook. We actually order food and have somebody deliver it. And it's very reasonable. And you could actually make, some people make $300, $500, $600 a day just doing that. And when you consider the cost of gas and so on, you can make an easy $350, $400 a day doing that. Some people actually pay their car loan installment doing that. All right, so that's an excellent idea in my view. There are other things that people could do. Certification and simple things. There are plenty courses offered by MIC and a lot of the different organizations, YTEP and so on, that teach people how to do all sorts of things. A friend of mine actually opened a business 2 years ago, servicing air conditioning units. He can't fix air conditioning. All they're doing is just cleaning air conditioning units. And they charge between $250 and $350 a pop. And they take about 20 or 30 minutes maximum per unit or per visit. And he was an engineer. Now he is doing about $18,000 to $20,000 per month with that business alone. He has 3 pickups, he has 12 employees, and he's doing great there. So these are some of the ideas we have in terms of reducing debt. And the last one I'd like to recommend is that if you're seriously in debt and need to get out of it, cut up your credit card. Destroy it. As painful as it would be, you could always try and get one back. When you get control of your expenses and of your debt, you could get it back after, right? One of the last ones I want to put as well is using something that is very archaic, very old-timey. It's called the envelope system. The envelope system involves pulling only cash to pay debts and to pay expenses on a monthly basis, and you put an envelope with each payment you have to make. So you minimize the use of your debit card. So that envelope, each envelope, one has a loan payment for credit union A, the next one have a loan payment for the bank, right? The next one have money for groceries. That is another excellent idea. And that is if you're really hardcore in terms of how badly off you are in terms of loan load, you could actually turn to that and do that as a short-term measure. One other short-term measure that is the last step I recommend in terms of managing your debt, and that is you could stop paying your annuity for a short period. If you're really in dire straits with debt, I usually recommend to people sometimes, in some cases, I don't like it, but I sometimes recommend you stop paying your annuity for a defined period, right? So you could take a 6-month break from paying your annuity, and normally people contribute 5 to 10% of their monthly income in an annuity, a personal annuity. We talk about company pension, right? And when you start back to COA and you get that little leeway from paying off 1 or 2 of the loans, then you could start back paying 15% for your annuity, and that would help. The insurance companies would charge you a little surcharge. They charge a little surcharge on those lump sums, but it will still be worth it in terms of the overall growth of your portfolio in terms of your annuity. All right. So that is the end of my presentation for now, and I'll hand over to Mr. Rollocks to deal with the questions and so on. Thank you.
Thank you very much, Mr. De Freitas. Wow, I know certainly we've gotten so much there, a very comprehensive, look at dealing with debt, managing debt, getting out of debt, and particularly for persons in dire straits. I know some tough advice, some bitter medicine there, but I'm sure efforts that can help. I know we have quite a number of questions and comments in the section, and we're looking out at time, and I'm hoping to get some feedback because we may run over by just about 10 minutes. So I'd like to see, maybe you can put in the comment section whether that's okay. If that's okay, we are going to take an extra 10 minutes, just 10 more minutes to wrap up and to deal with the questions. So please, indicate in the comment section. I know we have Simone there helping us out, and we have Alina helping us out there. So just indicate to me, what they're saying, and we will know how to proceed. Definitely, you could begin to put up the questions that we do have now. We can bring the panelists on. We'd like to, address your questions coming out of this particular presentation. And, so much of what has been shared speaks to the need to educate. Buyer beware. I've heard persons say this, buyer beware. You need to educate yourself. So let's see. We have a question from Alberta. How can you improve a poor credit score? I know that's something that we may have dealt with, but just give us 2 items, Mr. Thomas. Just 2 items of how to improve your credit score. You're on mute, so you need to unmute. Yes.
Yeah, nice. Sorry.
Thank you very much.
All right. So basically, to improve a person's credit score, we need to understand their financial dispositions. And based on the financial disposition, then we could assess and determine. Now, I know Mr. De Freitas said to cut up the credit cards, which is good, but that's actually one of the ways to actually improve your credit score by getting a credit card. Or, as I say again, join the credit union. Join the credit union and work with a credit union to take a micro loan. And with that micro loan, now you're going to show consistent payment, and that will help increase your credit score. Things like that.
Right. Great.
Yeah.
How do you avoid overborrowing? Ask yourself if it really adds to what you need or simply satisfies a want. Very good comment there. Thank you very much, Simone, for that. Yes, any other questions coming in? Okay, no other questions right now. So what we will do, all right, and if there are any other questions, we will deal with them after that point. But at this particular moment, we want to spend just about 3 minutes, Mr. Thomas, looking at a very interesting opportunity. All right, many of us who look at television, you look at cable, you will see all these companies offering all these opportunities to help improve your credit, right? But that is now here in Trinidad and Tobago. Cash Talk Credit Repair Services is here. So the CEO Mr. Thomas, is going to share a little bit about the company and some of the services that they offer. You'd see the number there, 272-1987, if you do want to connect with Mr. Thomas after. So he's going to take just about 3 or 4 minutes to share a little bit about what credit repair, Cash Talk Credit Repair does, and how this can benefit those persons who are struggling with their credit. So over to you, Mr. Thomas.
Nice, wonderful. Yeah, thanks again. Right. So for the person who just asks, how can they improve their poor credit score by being a member with Cash Talk Credit Repair Service, we can assist in that. So what is Cash Talk? Cash Talk is the only credit repair company actually located here in Trinidad and the Caribbean as we speak right now. Cash Talk have a few products that we provide for its members, and I just want to briefly share on it because I know we are crunched on time, and so I'm going to share. So we have something called the membership program with Cash Talk. Cash Talk membership program that allow its members to pay a monthly payment of $60 per month, and with that now we help them with financial management within our credit repair service. And we also help them in terms of persons who need microloans to purchase TVs, the glasses, student books, things like that. So just brief with Cash Talk, these are some of the things that we offer. So what is the credit repair? Credit repair is a client come to Cash Talk with their financial disputes. We write on behalf of the clients to the financial institution, discussing the financial issues, right, and trying to resolve it as best as possible. In terms of to repair your credit, we have a credit rehabilitation program where we work with the client month after month by providing microloans, working alongside the credit unions and some of the financial institutions. And by the client taking those loans, that actually automatically goes to Transunion and shows how you're going to improve your credit score. One of the most important things, so we have something called a guarantee program. So the guarantee program with Cash Talk is that a person who now taken a loan or a hire purchase, right? Cash Talk will now guarantee you up to $30,000. So just in the event a person cannot pay their loan on time, Cash Talk will now make those payments towards the financial institution and then have a sitting with you where we can discuss how you can repay. The reason for doing that is that once you cross your 30 days, we don't want your information going to TransUnion because we want to keep your credit score up on par. And so to cover all those services, I recommend be a part of the Cash Talk membership program, again, where you will have access to the guarantee program, you will have access to the credit rehabilitation program, right? The credit repair service, and again, the membership deal. The membership deal, again, is something that where persons who having financial struggles and they say a bed in courts, I don't want to go and purchase a bed, but don't have down payment, you are a member of Cash Talk, we can assist in those areas. Right? So guys, so I'm going to just leave the floor open. We just crunch on time. Mr. Relax, if you need to add anything towards those things, please feel free. So I'll pass it back on to you.
Hey, thank you very much, Mr. Thomas. So those individuals that you're out there and maybe you're struggling with your credit, you have a poor credit score and it's been difficult for you to move that score at all. We at VisionWorks, when we were exposed to this particular opportunity, felt it important to have Mr. Thomas share. At least you can take a look at what he has to offer. You saw the contact numbers there. So thank you very much, Mr. Thomas. So I'd just like to, I see a question coming in and we can pull our panelists back on. What advice do you give for getting out of mortgage overdue debt if it is your only debt and you have equity in the mortgage? Let me repeat that. What advice do you give for getting out of debt, getting out of mortgage overdue debt if it is the only debt and you have equity in the mortgage?
Do you want to take that one?
Richard?
Well, I'm going to start first and then with
Sure, yes.
So usually in a situation like that, I actually works with the financial institution and doing a debt consolidation. So that consolidation loan may actually help the person, Well,
they are saying in this case that they don't have any other debt. This is the only debt that they have.
Right, so which means to say that they are running to arrears, right? They are running to arrears, or they probably that the monthly payment is too high.
Right.
And they need to adjust the monthly payments. And these are some of the things that they actually face. So by restructuring the loan...
Also, you come in as an advocate, that's what you're saying?
Yeah, yes. So by restructuring the loan is one. right? To have a reduce our monthly payment or doing a consolidation loan, give it a different financial institution where they probably could offer a better monthly payment. And that's basically what is the client looking for. The salary probably, let's say 19,000 a month, and they probably spend about $9,000 within the monthly payment. So what they are looking for actually is to get a lower monthly payment so they can have more leverage in doing other things.
So
Yeah,
so why
Mr.
why
Richard?
can't given what you shared, why can't individuals just go and do this themselves? Why would they need someone to step in like an advocate? Isn't this something they can just arrange with their loans officer?
Yeah, no, so a lot of persons don't really have the ability to face the financial institutions in terms like that. All right. And wording is one of the most important things. How you structure your information and the pass on to the financial institution. So here at Cash Talk, where we sit with individuals like Ms. Joseph, and we work and we write letter on behalf of the client to the financial institution. One, to the financial institution that they have the mortgage with to restructure the loan. Now, if we cannot work there, then we look for consolidation loan with the next financial institution. So the
Okay,
whole
I
idea is to
understand.
provide those information so they can understand what position the client's in right now.
Okay, thank you.
Yeah,
Anything you care to add? Yes?
that's a really good point, Mr. Joseph made there, right? The thing about it is, a lot of times, people not aware. Just the other day, about 6 months ago, some friends of mine, they went into a mortgage about a significant property in a nice area, and they weren't qualifying with one bank, and they went to another bank, and actually the interest rate went from 9%, which is 0.75%, and reducing balance monthly. They actually ended up getting a 5% rate. The fact of the matter is that a lot of financial institutions have, even though we have a money crunch in the country, the banks have a lot of excess liquidity, and a lot of them are willing to compete. One of the important issues here is to determine if this mortgage Ms. Joseph is referring to, if it is a first mortgage on a property for home purposes, or whether it's a second or third mortgage, because that will determine the rate that most banks will know. We will all know that the banks use something called discriminatory pricing, based on
Right.
based on the level of collateral that being offered and so on. But once they think it's a good deal and the person has the ability to pay, even though I'm seeing the word overdue, right? You could go to a one or two financial institutions and get quotes. What you have to measure though is not just the what you'd be paying in terms of an installment. They might go from paying 10,000 to 7,000 a month because you're getting a nice rate, but you may have to pay 40,000 in legal fees to get the mortgage documentation and so on. So you have to weigh out all the pros and cons. Look at what they're offering. Look at what the installment going to be. Come up with a plan using somebody like Mr. Joseph in terms of helping to get out of the crunch, and using the particular talk needed to help you get out of that situation. You know,
Right. I see she's saying it's a first time home mortgage, 19 years.
19 years,
Yes.
right? Good. Yeah, so that's an excellent opportunity to look around a little bit. Now that seems like a mature mortgage, whether it's a 30-year overall, or or if it's a 20-year, which means that it's almost at the end of the life. So
Yes. Yes. Yes.
sometimes
Yes.
it's better just buy the bullet, and if it's for a year again, sometimes better just go with it and get it off.
Yes.
Sometimes what you need to do to is an inventory of what you have access to. Sometimes you have some little shares in a credit union that you don't have no business with again, or a fixed deposit somewhere sitting down. You may be able to use that to liquidate, right? Sometimes you're working at a company and you have 200 days vacation that worth
Yes.
$90,000. You understand? All these things is very important that we do an inventory of what we have and what we could use to help to defray debt.
Right. I see we have one more question here, and I want to ask you, and just before we take the question, just as we wrap up, I would like uh, each of the panelists here to think about if they had to think, if there was a silver bullet, that one thing that you feel would be so critical in helping persons deal, we've heard quite a lot tonight, deal with this challenge of debt. And we know debt can be a burden that people carry emotionally, physically. It can even impact your health. What would that one piece of advice, your closing piece of advice to them? But before you answer, we have a question here from Simone Nickham. Does debt consolidation help to repair credit? And if so, how soon does the credit rating improve? Does debt consolidation help to repair credit? And if so, how soon does the credit rating improve? I don't know if Mr. Daniel Thomas, you want to take this question?
Oh, sure. Yes. Yeah. So when we talk about the debt consolidations, right, to improve a credit, it doesn't actually work like that. Debt consolidation actually calls being financial smart, right? So you're being financial smart in terms of, yes, you know that you cannot pay your first and second and third and fourth month going forward, and your only option is time to consolidate, right? And by being financial smart, that will help you improve your credit score, right? Because if you're not financial smart, you will run into debt, and then you realize the bank come and foreclose your property,
Oh, so it's an
right?
indirect impact.
Yes,
Mm-hmm.
yes.
Okay.
No, so we talk about credit score. Now, the credit score don't happen overnight within 14 days, because you have to remember that you are still currently paying your loan, and that will be on the system, right? Usually, a credit score actually raised after when a loan is completed, because during that period, they tend to do a track record to track how late
Oh,
you pay.
okay.
How time,
Okay,
yes, so
okay,
these are the
okay.
things, and based on every loan that you take and instructed, actually help raise your credit score. That's why I
Okay,
always
great.
tell persons start with something small, right? Because you
Yes.
start with a $5,000, you start with $5,000, and you start with $100,000. It's the same credit score you're gonna get it.
So this is something you can encourage, even maybe we
Yes,
have parents listening in, you know, you can
yes,
encourage your children. This is something you encourage parents to do for their children as well.
yes.
We're talking about maybe
Right.
teenagers, young teenagers going out in the world of work, you know.
Yes, I believe at the age of 18, as I say again, so I know most of the credit unions have a junior saving program. By the junior saving program and all that actually shows up within the credit union,
Oh, okay,
where when I was
okay,
14, 15, 16 years, that you're consistently paying. And when they move on now to actually take a loan, it actually helps. So
okay,
again,
okay.
find yourself in the junior, saving programs or with sort of financial institution that provide that service, get them involved in those things.
Excellent.
Yes.
Well, gentlemen, we've had so much. I don't know, I'm not seeing any more questions, but we've had so much this evening. You know, we spoke about the issue of what debt is and the difference between debt and credit, and the whole idea that debt is good if well managed. We spoke to the issue of understanding a credit score, which ranges between 200 and 850, and it's something that builds over time. And the earlier we begin, you know, we can actually develop a good credit rating. And then we had quite a number of tips from Mr. De Freitas as to how to deal with that and get out of that. So certainly for those of you listening, if you feel you'd want us to expand on any one of these areas, you know, put in your comments, go onto the Facebook, send a message so that we will know how to further explore, expand this particular and very important topic. But just as we wrap up, I'd like to hear it from the presenters, and thank you so much for taking the time to be here and the effort to prepare and to share with our viewers. But just in wrapping up, one thing that you will encourage persons to do to help them to deal with the issue of getting out of debt. So let's begin with Richard, Mr. Rollock. Richard?
Yeah, one of the things I would say, in terms of getting out of debt, I would say consult a professional. Um, a lot of times people end up in these situations because they try to do the loan, and I mean, in other spheres of life, we would usually consult a professional. If it's our health, if your car not working, you will go by a mechanic. If it is that you're not feeling well, you go by a doctor. I think if it is that you have issues with that you should consult a professional, someone who knows, the ins and out of how to deal with it and manage it, rather than going at it alone.
Okay, thank you very much, Richard. Mr. Thomas, what's that one
Right.
thing you'd like
So,
to share, yes, with our viewers or listeners?
all right. So basically, our viewers today on the information we just shared, um, Mr. De Freitas had shared something called discipline, which is one of the most important things that we need to discipline ourselves in terms of our buying power. Yes, we may have buying power, and we are being watched via the internet. For everything that we search upon, it will start to pop up, basically on the social media, just to encourage you to spend, right? So those are one of the things. Financial literacy is also something, and get yourself involved with a professional. Now with Cash Talk, there's a group of professionals and also a group of attorneys. So if anyone needs any financial advice, who are having any problems with the financial institutions, we should do so. And I just want to share one thing on why it is the credit repair company started off, because myself, I had over 19 years in problems with a credit card from Scotiabank, and I didn't have anyone to actually help me. And that's how I actually started off the credit repair company. So guys, yes, we are here with Cash Talk. There's a panel here who are willing to share basically this information every Friday, right? So just work with a professional, and please discipline yourself when coming to financial literacy. Thanks again.
Thank you very much. Mr. De Freitas.
Yes, thank you very much. Thank you very much, Mr. Rollock. So I'd like to say, one of the things I'd like to add is that the biggest thing, I think, to help people to manage debt and to stay out of excess is really to achieve something I like to refer to as mental shift. We have to take a serious look at our self-concept and move away from the ravages and the current of consumerism. And we have to regain our self-leadership and our right to determine our life and our direction, right? So we need to unwrap our heads around away from the consumerism and get it around, an attitude of victory, right? Based on, again, that self-discipline to make sure and make the right decisions in terms of what we buy, what we do buy. We ask ourselves those questions that Simone had graciously shared with us earlier. Ask yourself the question: Would this add to my life or take away from it? Would I be satisfied having this item or whatever 2 months from now, or would it just become a clothes rack? Right? So basically, that is it. We have to really use discipline. And the other thing I would advocate for is that we in Trinidad need to look at something we call multiple sources of income. Many of us have the concept that you go and you work in a job, and I think the millennials and the Gen Y and Zs have it better, right? I'm a baby boomer, but the Gen Y and Z in Trinidad have it a little better. The carnival mojo kind of get killed, but they are the ones who understand the value of carnival, and a lot of them are making plenty money off for the industry, So I think we are in the right direction there, and I think more people need to get involved in getting multiple sources of income. Different things. For example, if you have discretionary income, you don't know what to do with, invest in some stocks. You'll be surprised after 5 years what your portfolio may look like if you make the right decisions. Get in touch with a broker. There are a lot of good ones. You have JMMB, you have most of the banks, FCB, all these banks offer that type of service, a brokerage service. They have a lot of private companies as well. Get in touch with some of them, Wise, Boss, and so on, and find out what's out there. Make yourself an owner of equity. Move away from the thing about going and work in a company till age 60. That's a waste of time, right? Think more entrepreneurially. That's the takeaway I want to leave with everybody.
Yes, thank you very much, Mr. De Freitas, and thank you very much to our panel. I want to thank you, the viewers, for taking the time and giving us that little extra time at the end to wrap up a very powerful and one we hope to be very helpful discussion this evening. Thank you very much to our support, Simon Nickham, who's been helping us in the comment section. Thank you very much for our producer, LSC Productions. Yes, thank you very much to LSC Productions for our production this evening. And just in closing, just to say to you that remember, you are your most important asset. We've been talking a lot about assets and having assets. Make sure you invest in you and invest in the time and energy to know. Investing in time and energy to know and to execute is very important. So tune in to VisionWorks. Check us out on our Facebook. Check us out on LinkedIn. Check us out online, www.visionworks.solutions. Visionworks.solutions, and you can find out more about what the kind of help you can achieve or become a part of what we call the impact community, because we intend to impact the world together. So thank you very much. Have a pleasant night, and until we meet you again on another VisionWorks Financial Fridays. So long.
Thank you.
Bye, everybody.